Hi, everyone. I appreciate you deciding to take this class. I think you'll find that it's going to be extremely helpful in improving your trading abilities and reducing the amount of stress and uncertainty that you experience when you're trading. It's going to be a very methodical, scientific kind of way of trading so that you're not going to be emotionally driven and not worried about positions day and night the way most people do when they're living in what I call the forecasting paradigm. So I would, in small classes, I would normally ask people, what their experience has been and so forth, but there's a total of 11 people in the class, so it's going to be a little too much to go through. So I'm just going to get started with the general concepts, and then maybe over time we can hear some stories of those who have, had good experiences, bad experiences, and then eventually how the class changes your trading skills. Okay, so to begin with, the most important thing to realize about markets is that the way that most people think about markets is, and the way that I thought about them for at least 20 years, is the forecasting paradigm. They come in with the belief that to be able to trade a market, you have to be able to predict a market, and that the only way you can predict markets is use, various elaborate kinds of techniques and moving averages and possibly wave theory, and some people use astrology or whatever it is. So using some kind of approach to help them to decide what the markets are going to do, and then taking that information and trying to make money trading from it. And over time, I'm going to show you that not only is that not the best way to go, but it's actually counterproductive. When you're dealing with forecasts, it involves your ego and your emotions and your self-confidence and things that can be detrimental to good trading strategy as the market unfolds in a particular direction. So there's gonna be a lot of things to talk about, which is why the class is 3 months long. And I'm gonna try to build it up little by little, one concept at a time, so that it's manageable. It gives you time to practice the ideas and the concepts. There'll be some homework assignments for about the first month, and then we'll get into real-time analysis and then eventually real-time trading, and go through the whole steps of how you look at how you find things to trade, how you decide when and where to get in, and then how you manage those positions. So there's 3 primary steps to market trading, and we'll be covering all 3 of those. Okay, so let's move on to the first section here. So why are markets like rivers? I'm going to give you some examples a little bit later. Hopefully we'll have time for it today, about how the market breaks down into typical river structure and what kind of techniques and technical indicators, fundamental, psychological, where they apply in different parts of the river, and how you can use that information to trade better and trade unemotionally. So when it comes to a body of water, there's 2 states it can be in. Either it can be moving or it can be stagnant. So if it's stagnant, we call it a lake. If it's moving, we call it a river. So under river theory, there'll be 2 different conditions the market can be in: a lake environment where you're going, sideways and not doing very much, and a river environment where the market's trending and going somewhere. But in a real lake, there's lots of things that can happen that make the behavior of things in the water and on top of the water very random. You can have convection currents, the hot water, the water that's being heated might rise to the top, the cold water sinks to the bottom. You have the wind blowing across the top of the water. You might have people and fish moving around. So a lot of random things can happen that cause it to be, unpredictable. So if you were to take some ping pong balls and you throw them up in the air, and before they go to land, you get the world's best computer and put in all the inputs of how you threw them and the angle you threw them at and how they're falling and the wind speed and all these different things. No computer system in the world would be able to predict where those balls are going to be with any high degree of certainty, maybe in 5 or 10 or 20 minutes, because there's a lot of things that can happen that will change where they end up. So that randomness makes, that unpredictableness makes it difficult to deal with what I would consider a lake environments. river environments where the markets are trending in a particular direction will be much easier to deal with, and you can make money much quicker when markets are going somewhere, even if you've missed the top or the bottom. When it comes to water, again, the phenomenon that changes things is gravity. So if you're in a lake environment, the only way that that changes is if one side of the lake gets broken, such as a dam or something, and gravity takes over and it starts moving that water in a particular way. So you go from this non-trending random behavior to all of a sudden you get much more predictable action. So when gravity is involved and water is moving, it starts to involve what's called fluid dynamics. And you'll get friction that takes place as the water rubs against the north or the south bank of the river. You know, water obviously seeks the lowest level, and the minute it does that, there's always going to be a north and south bank as it's traveling in a particular direction. So as the water rubs against the top, it creates friction, which creates turbulence near the top and the bottom, and you have your more trendy action outside of what I call the event horizon, and the fastest movement will take place in the middle of the river. So this creates three types of behavior three main types of behavior in a river. We have zone of turbulence or range of turbulence, directional movement, and then another range of turbulence. And eventually we're going to break this trendy part into two parts, where there'll be sort of normal trend and then the rapids or the acceleration phase. So you have your turbulence, your trend, and your rapids. And that's the three primary zones of a river. And this creates three types of trading zones when it comes to markets. So I'm going to transition here from a lake environment to a market environment. And again, in a market, you can have a lot of random things happening. The amount of buying and selling is about the same. So the market's not really going up or down. It's might be affected by random news events that come out, but it's not going anywhere for a while because there's no change in the current conditions. What changes the direction of a market is money starting to move clearly in a direction. Either money's pouring in or money's coming out of a market, and that'll create either uptrends or downtrends. So as there is increasing amount of demand, just like if you go to a store or any popular product, the more demand there is, the higher the price, the less the demand, the lower the price. So think of that in terms of money pouring into a particular direction for a particular product or stock or index, or coming out of a particular stock or index or item. And as that money moves in one direction, either up, going in, or out, going down, that creates particular and specific movement in the stock. So obviously money flowing in produces upward price pressure, money coming out, lower price pressure. Now, obviously with markets, there's always a time element. So it's always moving to the right on charts. So that time is always taking place. So when I talk about lake environments for markets, it's mostly where a market's just going back and forth and not going anywhere, but time is obviously always moving to the right. So this creates in markets the same phenomenon we saw or talked about in rivers, where we have a zone of turbulence that takes place typically near major market tops or bottoms. And as you finally finish a phase of accumulation or distribution, then you move into the trendier period, and eventually you get into the acceleration period right in the middle. And if you can find an acceleration zone that's really big, then you can make a lot of money fairly easy for a long period of time. You know, think Microsoft or Apple or possibly Tesla, things like that, where they've just been trending incredibly for very long periods of time. So these three zones of behavior create three types of behavior: choppiness near the top or the bottom, and trendierness near the middle, with the most trendy action in the center of the river, a little trendier here, but most trendy there, and then much more turbulent at the top and the bottom. So let's say that you're near the edge of a river and you pick up a tennis ball and there's a little bit of weight to it, and you place it at the edge of the river. Obviously, if the river is going this way, it's not going to just go perfectly horizontal like this, because it's going to get caught in the turbulence. It's going to move back and forth. Eventually, it might break out beyond the event horizon, and start getting into the trendier part of the river, start accelerating at the same time that it's going this direction. It's moving down this direction, so it creates an angle. And then this part here should actually be down here, but I didn't want to have it overlap the words. So this choppiness would be down in this section. And if you are familiar with wave theory, you start to realize that this kind of behavior is a direct reflection of wave theory and explains why markets move in this kind of way, where you have your waves 1 and 2, and then the acceleration for wave 3, and the choppiness for wave 4, and the conclusion for wave 5. So I feel that river theory is actually a superset of wave theory, that wave theory is inside of river theory, and there's periods when wave theory works and when it doesn't work as well because of the position that it's in within a larger river. So let's look at some real world examples now. I want you to realize that these channels that are drawn here are going to be objectively drawn. So later on, as we go through the classes and the homework assignments and so forth, eventually I'm going to show you how to draw objectively designed channels. So that's not designed the way you might visually do it, but the market's going to tell you where to place these channels and how, and where to put the event horizon, and know where a market's likely to consolidate, accelerate, and get choppy. So the other thing to realize is that these channels will not be perfectly horizontal. Markets go up, they go down, they go sideways, they can expand, they can contract. So when we talk about turbulence and trendiness, that turbulence can happen at an upward angle, like what occurred here. You can see it's chopping. When you look at the location it's occurring in within the channel, you can see it's choppy in that zone, but most people would look at this if we took the channel away and just say it's in an uptrend. But from a river perspective, this would be the turbulent zone here, this would be the acceleration zone, and this would be the turbulent zone. So it's chopping around the bottom of the area of the channel, then it starts to accelerate, gets in the top of the channel, and then it starts getting choppy again, then accelerates back through the middle of the channel, and then it starts chopping around again. Here's another one a little less pure than the first chart, where it's chopping around a little more wildly in the upper section. Then it starts to accelerate through the midsection to the bottom, chops around a little bit here, and then it starts to accelerate back up. And this one does something new. It breaks out of the channel, but you can see initially it's playing around inside of the congestion zone, then it accelerates, plays around the bottom congestion zone, then it breaks out. So this is a behavior that we'll talk about later that can produce really violent price action when you move outside of the channel. Now these channels are going to be determined by larger time frames, and they're going to be imposed on smaller time frames, and I'll get into how that's done later on. Okay, so that gives you a quick overview of how markets and rivers have similar kinds of behavior and how we're going to use that to structure the market and determine what phase of a stock or index, what phase it's in within a river, and how it should be traded based on that. Determine whether we should be dealing with stocks or whether we should be dealing with options, long-term options, short-term options, things like that. I'd like to go on to the next part, which is discussing the forecasting paradigm and why it produces the problems that it does, and why most people who come into the market with the common belief that forecasting is the answer to trading, why that doesn't work. So when it comes to the forecasting approach, I would say that the vast majority of time that people spend when they're involved in the markets, they're spending the vast majority of the time trying to forecast what's going to happen in a particular market, and then using that information to eventually get in and hopefully make money when they get out. But this is where most of the time is probably spent, on the forecasting part, just determining what you're going to trade and what's going up, what's going down, when, how, where, and all that stuff. So let's pretend or assume that the accuracy of your forecast is 50%. So half the time you're right, half the time you're wrong. And that might be generous. I'd say a lot of times it's probably worse than that, but we're just going to be, split it right down the middle, say you're right half the time, you're wrong half the time. Then you have to worry about, if you think the market's going up, when are you going to get in and where, what price and what date. So you have to then forecast or predict when you're going to get in and where you're going to get in. And let's say that you're right about half the time on that situation. Then once you're in, most people using the forecasting paradigm will then work on predicting when they're going to get out. And if you're right on half of your exits, then you do the math. And if you start off with 50% of the directional forecasts are correct, then 50% of your entries are correct, and 50% of your exits are correct, you end up with a trading accuracy of about 12.5%. And that's why the forecasting paradigm doesn't work, because you're having to be too right too often about too much. And so the key is to try to get rid of as most of this process as possible, so you're only left with a 50-50 chance of making money. And then through proper money management, you can actually make sure that your winning trades are held longer than your losing trades, and you're cutting your losses much quicker than you're cutting your winning trades. So over a long period of time, the net result will be a profit. So let me just rediscuss this real quick. Let's say that you predict the trend is up, and it turns out that you're right. Let's say you're looking at the gold market and it's at $1,000, and you decide that you're going to get in at $950 because you think it's going to $2,000. Let's say it goes all the way down to $960 and then it goes to $2,000. Well, then you missed getting in. So there's a good forecast, but you never got in, so you didn't make any money. Or let's say that you wanted to get in at $950, it drops to $950, you get in, but then it keeps going down and your stop is at $900 and you get stopped out, and then it goes to $2,000. Well, again, your forecast was right, but your trade lost money. Let's say that the forecast was right and the entry was right. So you got in at $950, it went to $940, and then it turns around and it goes to $1,990, and your exit is at $2,000. And then it goes from $1,990 all the way back down to $1,000 or $900. So you gave up all your money and potentially got stopped out, so you lost money or you didn't make any money. Or let's say that your forecast was right, your entry was right, and it at least made it to 2,000. So you made money on the trade, but then it goes to 4,000. So you actually gave up half of your, or 2/3 of your potential profit on that trade. So every time you're applying the forecasting paradigm to direction, entry, and exit, you're reducing by 50% or more your chances of being successful in the end result. That's the reason that that process is not very productive. So the goal is to try to get rid of most of that, so that you're left mostly with just deciding when and how you're going to exit, letting the market define its own direction without you having to predict it, letting the market define how and when, where you're going to enter without having to predict it. And then the only part you'll have to decide is your exit, and generally only about 1/3 or 1/2 of that has to be decided. The rest of it can be defined by mathematics. So if you're right half the time after you're eliminating these two parts, if you're right on your exit half the time and you're wrong half the time, but your winners are making 3 times more or greater than your losers, then in the end, you're going to make money. So that's what river theory is all about, is getting rid of the forecasting part of trading, getting rid of all the emotionalism, and then focusing on letting the market dictate to you what the trend is, how you're going to enter, when and where you're going to enter, and then focusing on exiting with at least 1/3 to 2/3 of that position being automatically exited at certain points. And the final 1/3 is sort of a decision to be made by you. Okay, so question is, how can we do this? How can we trade without forecasting? Well, we have to start with a very logical foundation that is not disputable. When most people get involved in markets, not only do they immediately assume that forecasting is the key, but then they have to pick what kind of philosophy they're going to use. Are they going to use, moving averages, or interest rates, or astrology, or wave theory, or some other computer system, whatever it is? They have to decide what they're going to use to trade the markets. But we want an approach that is not based on opinion. It's based on visual, observable facts. And that's going to be a huge differentiator between river theory and most forms of trading and approaching the markets. Then we're going to have to categorize traders into different types. Those who are buying during market declines, those who are buying on market advances, those who are buying on market pullbacks, or selling in the same vein, new highs, new lows, or pullbacks. We have to determine how they're entering the markets based on the style of trading, and then talk about something that you never hear about, which is financial capacity. This has to do with how much money someone's working with. If you're working with $10,000, your trading style and time frame has to be drastically different than someone who's trading $1 billion. You can't day trade $1 billion. You need to have much longer periods of time, because if you're working with $1 billion, you need 1 million people with $1,000 or 1,000 people with $1 million to do the opposite of what you're doing, so you can get in while they're getting out, or vice versa. So the larger the amount of money, the more you're at the mercy of the whims and emotions of the public. You're having to wait for them to do something so you can get in while they get out, or vice versa. So when we're dealing with a concrete approach to markets, we want something that is only focused on facts, not philosophy, that allows us to actually track the control of a market through the different players. You may hear of some people saying, well, I'm a trend trader, or I'm a top and bottom picker, or I'm a bargain hunter, or I'm a fundamental trader, or whatever. The minute you pick one of those categories, you're automatically designing or using a system that has to be, by definition, wrong probably 2/3 of the time. Because there's only 3 ways you can trade. You can top and bottom pick, you can bargain hunt, or you can trend follow. Those are the only 3 ways you can trade, no matter what system you're using. You're always going to be buying near the top, the middle, or the bottom, selling near the top, the middle, or the bottom of any range that you decide, daily, weekly, or monthly. So those are the only 3 ways that you can ever trade, no matter what the foundation of the system. The minute you pick one of those 3, then you've locked out the other 2, and you are going to prevent yourself from making money probably about 2/3 of the time, probably maybe breaking even 1/3, losing money 1/3, and maybe making money 1/3 of the time. So the goal is to show you how to follow the current market conditions and adjust the way that you trade to fit the market environment, instead of saying, well, I'm a trend trader and only buying into new highs, or selling into new lows, or only using moving averages, or whatever, so that you're adjusting how you approach the market based on what it's telling you is the current or new environment. And I'll show you over a period of time, by tracking all 3 different types of traders, how we can determine who's in control of a market, where that control begins and ends, and how it shifts behavior. And you eventually will be able to look at a chart, a bar chart, and be able to say, well, this is a bargain hunting environment, this is a trending environment, this is an acceleration environment, this is a fundamental environment, this is a technical environment, or this is a psychological environment. So let's move on to where we're going to start this process, and this will be part of our first homework assignment. When it comes to making or losing money, moving averages, news, sentiment, government reports, things like that don't determine whether you make money or not. It's not about your philosophy or your beliefs, or whether you think the market's going up or down. The only thing that decides whether you're going to make or lose money in a market is the movement of price. So if you're long, even if there's a nuclear war, if you're long and the market goes up, you're going to make money. If you're long and the market goes down, you're going to lose money. So it's the movement of price that we want to focus on, because everything else is just an opinion. Price is the ultimate final decider of whether you're going to be right or wrong in your investments. So when it comes to markets, we want to create this solid foundation, indisputable, indestructible, uncorruptible, unchangeable foundation. We want to begin with the most common kind of chart that's existed throughout history, which are bar charts. And on a bar chart, there's only 4 realities that exist. And that's up bars, down bars, outside bars, and inside bars. And so what we want to do is we want to define and understand what each bar means in relation to the prior bar and start to build an elaborate series of control lines that will eventually define who's in charge of the market that we're looking at, where that control began, how we should be trading it based on that control, the kind of behavior we're going to see because of that control, and then how we're going to create channels based on that control, and how we're going to enter and exit the market based on that. So when it comes to bar charts, for a while, we're just going to assume all of the charts we're working with are daily bar charts. And when I give you any homework assignments, it should only be based on daily charts for a while. Eventually, we'll expand out to weekly, monthly, maybe hourly, but initially, just everything's going to be based on daily charts. Okay, so when it comes to a daily bar chart, if you see an up bar, you know that that means for that particular day, let's assume we're talking about this one right here, for that particular day, all the people who were buying were willing to pay more on this day than they were willing to pay on the previous day. So all what I call the retail traders were willing to pay more, the wholesale traders, those getting into the lows, were willing to pay more, and you can say the middlemen in the center of the trend were willing to pay more than the previous day. So for that one bar, no matter what happens after, for that one bar, the buyers were in charge of the market for that one day. When you have a down bar, obviously everything is flipped upside down. The sellers were willing to sell at a lower price, both on a retail, wholesale, and middleman kind of basis. When you get an inside bar, this means that the market and the traders are sort of resting. Nobody's paying more, nobody's paying less. The market is sort of going into, you could say, hibernation, and there's no one in control of that particular bar because we don't know what's going to happen next, and we don't know what they were doing. We just know it wasn't pushing the market higher, it wasn't pushing it lower. And then when you get an outside bar, that's when both sides, the buyers and the sellers, are trying to take control of the market, but we don't know for sure who's actually going to win. And I'll talk about how to deal with that shortly. So in this particular case, when you get an outside bar, you're assuming that both are attempting control, but we'll need to discuss how we determine who's likely still in control. So these four bars are the only kind of bars that exist on a bar chart. There'll never be any more, there'll never be any less. So we don't have to worry about the foundation of our theory changing. And there's a logic behind what we're talking about so that we know we're dealing with, reason. We're not dealing with beliefs and philosophies and connection between the moon and the stars and, things like that, things that are more nebulous connections to the market, not concrete connections. Like, for example, if the market goes one tick above this high on a daily chart, that a lot of people who were short might be stopped out. A lot of people who wanted to go long might be stopped in. Those who are long are making more money. Those who were short are losing more money. That's just a fact. That's not a debatable subject. So we want to deal with things that are factually based, not emotionally or opinion based. I want to deal with one issue we have to discuss before we can move on, and that's how to deal with identical highs and lows. When you have an identical high, because most people who trade off of bar charts will use highs and lows of previous bars as stops if they're going to, have a stop at all. That one tick makes a big difference. If this high is exactly the same as this one, let's say this is 100, this is 100, 100.01 would start to stop some people out or stop some people in, or it indicates whoever's long is starting to make a little bit more money, but it does make a difference. So you might stop out a lot of people or stop in a lot of people by going that one tick higher. So that one tick makes a difference, and for that reason, if your highs are identical, this bar is considered an inside bar. If this low were also identical, the entire bar would be an inside bar. If it's one tick lower, and this is exactly the same as this, that would be considered a down bar. Same thing here. If it's one tick lower, it's a down bar. It's exactly the same. It's an inside bar. Any higher amount inside bar, as long as this high is lower or the same, it's an inside bar. Okay, now I didn't mention to y'all earlier, there's a question and answer section in your GoToWebinar control panel. So if you had a question or something you're not understanding, you can type in your question in that section. I can open it up occasionally and take a look and see if there's any questions that are coming in. It's also nice to see that everybody except one person is here today, so we got most of the class in on the first day. Okay, so let's talk about how we're going to deal with, or how we're going to use this information, understanding that an up bar indicates that buying power is greater and that the buyers are in charge for the up bars, and that down bars, sellers are in charge. Inside bars, nobody's in charge, and outside bars is a split control, which will have to be decided by the market. So if we're looking at a chart here and the market had been declining, and all of a sudden we get an up bar, that's an indication that this bar is under the control of buyers, or that particular day the buyers were in charge. So we want to note that event by having a motion line that touches the top of that bar. So let's say the motion line had previously been going down because the market had been declining and the sellers were in charge. All of a sudden you get an up bar. Your motion line is going to go from the low to the high of this bar. If the market was already going up, then you just continue from the previous bar to the new high. So no matter whether it's a first up bar in a while or just continues, the motion line will go from where it was, either at a low to the high or at a high to the high. That's how you deal with up bars. Obviously, down bars are going to be exactly the opposite. Give me a second, I got to drink some hot water here. My voice starts to get a little raw after talking nonstop. Okay, so down bars would be just the opposite. If the motion line had been going up, you get a down bar, you go from the high down to the low. If it had previously been going down, you go from the low to the new low. When we go to inside bars, that's a bar where no one's in charge. There's no evidence of changing conditions. Remember that one tick makes a difference, and that one tick is going to change the financial landscape. It's going to mean more people are stopped in or stopped out, more people are making money or losing money, so it has a financial impact. When you get an inside bar, there's virtually no financial impact. So we're not interested in events where there's no financial impact. We want to know, are we making more money or we're losing more money, not when nothing is changing. So when you get an inside bar, we don't count those. Now, what's very important to understand is that the motion line is touching some bars and not touching other bars. So it's not going to be touching inside bars. So once you get a motion line that touches a bar and is followed by an inside bar, you have to go back and notice the high and the low of the last bar that touched the line, because you're not going to be worried about any bar after that until this high or this low is broken. It could be, a slight up bar in relation to this, slight down bar. None of that's going to matter until we make a new high or new low. Otherwise, it's just wasting time, but not having new financial impact. So if the motion line was going down, you get an inside bar, it just stays here until we break either this high or this low. If it breaks the low in the future, you go down. If it breaks the high, you go up. Same thing going the other direction. Outside bars create a slightly more complicated situation. And this is the first point at which we're going to have to take, 1 foot out of the purely logical observations and pure objective tracking of the market and make some assumptions using physics. So we have in space and on Earth, an object in motion tends to stay in motion. So momentum applies to money the way it applies to physical objects. So if money, billions of dollars is pouring into a market, that doesn't turn around on a dime. $1 billion are coming out of a market, it doesn't turn around on a dime. It takes time for large amounts of money to switch hands with a lot of small traders so that you create a top or a bottom and the trend can reverse. So when you get an outside bar, we're going to use the concepts of inertia and momentum to determine who's likely to be in charge of the bar that has created the outside event. So in this particular case, the motion line was going down previously. So when we get this outside bar, we're just going to assume that the momentum and inertia still favors that the sellers are in charge, even though it broke above the high. The more likely reality, and this you'll see this is true most of the time, that inertia and momentum will favor whatever direction the motion line was previously going. So if it was going down, you're just going to go to the low of that bar. In this case, this goes back to an inside bar situation. As long as you don't break this high or this low or this high or this low, everything that goes this direction is an inside bar. So in this particular case, we have an inside bar after a down bar. This bar is not being compared to this. This is not an outside bar. This is an up bar in relation to this bar. So if you see a bar that looks like this, you're going to ignore the inside bars. You're not going to look at any bars that don't touch the motion line and compare this bar to the last bar that touched the motion line. So this is an up bar. In this case, the motion line was going down. Here's an outside bar. It's just what I call a normal outside bar. So you just continue the trend, continue the inertia, the momentum down to the low. Okay, on the upside, if the outside bar happens after the market's been moving up for a while, you just continue the inertia momentum to the high. You just ignore the low. Again, if you have an inside bar before what you think is an outside bar, but when you compare this to the bar that counts, the one that touches the motion line, not the one that doesn't, then this qualifies as a down bar. So just make sure you're very careful about noticing which bars touch the motion line and which ones don't, and only pay attention to the ones that do. The highs and lows are the ones that do. So let's leave us with one final bar to deal with, and that's what I call a violent outside bar. These diagrams were drawn a long time ago. They're actually drawn incorrectly. I've come to realize over the last 20 years or so that they need to be done a little bit differently. So let's say that the market had been moving down, the motion line had been going down because the bars were going lower. Then you get this violent outside bar. So it's like an outside bar, sort of like this one, but the high of this bar ends up exceeding the turn of one bigger degree. See, each one of these bars is like a lower degree. If you have a motion line that goes up and turns down, it's a combination of many bars together. So this creates a larger degree of trend change than one bar at a time. So when you have a change in the direction of the motion line, it's considered a larger degree. So when you get a violent outside bar, it means that that bar's high or low goes beyond a previous turn of the motion line. So it previously been going up, goes down, and then eventually that outside bar, you may start down here before the day's over, it exceeds this high, and that's what I would call a violent outside bar. So let's pretend that the day starts like this, and you just draw your motion line to the low, and then as the day progresses, it keeps making new highs, and eventually it exceeds this high. So all of a sudden your motion line needs to also go to the high. So this will create a double plot. Instead of it being drawn like this chart, you're first going to go to the low like this diagram here. And then as the day progresses, you're eventually going to notice that this high was higher than this. So you're going to draw your motion line from this low and go straight up to the high. So you're going to double plot the same bar because this bar is so large that it has dual significance. The end of an old trend, the start of a new trend. So we plot both the low and the high. Now, when you go in to do your charts, very important that you don't have colored charts, you don't have candlesticks, you don't have red bars and green bars and all that kind of stuff. You want only two possibilities, a white background with black bars or a black background with white bars, because we're going to end up color coding all kinds of stuff on the chart to determine who's in control and where it starts and all kinds of things. So it's important that all your charts are just single bar charts. You can have the open and the close, and it should just be a black line or a white line against a black background, and that's it. So in this chart, you have your motion line, which should be done in gray, exactly halfway between black and white. So you have a gray motion line that goes down to the low, and then at the end of the day, you would go straight up to the high. So you'll see the gray line, the black bar, and the white background, or vice versa. If the motion line had been going up and you open up in this area, you make your high first, the motion line would go to the high, and then by the end of the day, you see that this low broke this low here, the motion line low, you would go straight from the high down to the low. So you double plot that violent outside bar. This only applies to violent outside bars. Okay, so this will be the first step in your homework assignments. So you'll want to get a piece of paper out and write this down. First thing you're going to want to do on your computer or however you plot charts, you're going to want to find a daily bar chart that only covers 2 months. So this is mid-October, so should be for say August 20th, September 20th, October 20th. So it'll be 2 months of time, and it'll be a daily bar chart only. And then first thing you're going to want to do is identify the highest high and the lowest low on that chart. Okay, so the lowest low will be LL, the highest high will be HH. So in this chart, just happens to be the lowest low came first, the highest high came second. Okay, so once you've identified those 2 points, then you only want to circle, this is important, don't circle both of them, you only want to circle the first of those 2, and if you can color code it, preferably in blue. Later on it'll be obvious why we do this, but I'm not going to get into that now. So you're going to circle this low because it occurred first. You have LL, HH, you circle only the first of the 2, and that's where you're going to begin this motion line analysis of drawing, across highs and lows and inside bars and outside bars and so forth. So you circle this low, and then right in the center of the circle, you put a little dot in gray, and this is where you would start drawing your line. So the first bar is an up bar, so you would go from this low to this high. Then you have 1, 2, 3, 4 inside bars because they're not higher or lower than this bar. Then you have a new bar that's above the high of this bar and above the low, so this makes this an up bar. So your motion line would go from here to here to here. Then you have another up bar, 2 inside bars. You skip those, you just ignore them. Then you go to here, then to here. Then you have your first down bar. Then you have 1, 2, 3, 4 bars that are below this high and above this low. So your motion line is just sitting here waiting for this high or this low to be exceeded. Finally gets exceeded there. Then again, you have 4 bars in a row that are inside. So your motion line stays here until all of a sudden it goes down, down, and then you're going to continue the momentum and inertia first as it makes the new low. Then at the end of the day, you notice it's an outside bar, but it's just a normal outside bar because this high did not exceed the previous motion line peak, which was over here. So it's just a normal outside bar, and you just go to the low and that's it. And the next day you go to the high, and you go to the low, and you go to the high, and then the high, and then the low. And then again, your momentum was going downward, so you go to the low first. Before the day's over, you notice it's another outside bar, but this time it exceeded this particular high, so it'd be a violent outside bar. So your motion line would go from here to here to here, and then before the day's over, it goes straight up to the high. Then from there, the next day, you go up to this high, then you skip the next 3 bars. So you go from this high down to this low. The motion line is going down, so as the day is unfolding, it's not clear what, maybe the high happened first, it probably did. So you may have drawn it to the high, but before the day's over, you realize this is just a normal outside bar and you would have to draw from here to here. So as a general rule, it's better just to wait till the day's over before you do these things. But the motion line would go from here to here to here. And this is just a normal outside bar because the opposite side did not break the previous motion line turning point. Go down to this low, skip a few bars and so forth. So that would be how it would be done on a typical daily bar chart. I'm going to go to a new one here. So let me see, open up the audience here a second. Does anyone want to take a shot at this particular chart? I'm not sure if you know how you can raise your hand or you can throw in a question and answer section where you just say, you'd like to give it a try, but I'm just going to pick somebody at random. Smith, do you mind if you can unlock your mic? We can quickly go through this so we get a quick practice in real time, and then we can move on to the end of the session for today. Smith, is your mic unlocked? Do you know how to unlock it? Stephen, your mic's unlocked. Can you say hello or? Stephen?
Oh, yes, hi. Can you hear me okay?
Yeah, I can hear you. How's it going?
Yeah, very good. Thank you very much. It's lunchtime here in Australia. So yeah, just going over to the left, I would start at the high of that very first bar because I can see we're in an uptrend.
Okay, I'm going to give you the ability to draw on your chart. Have you ever used
Sure.
GoToWebinar? I'm going to allow you to draw, and if you go to your control panel, it has a little pin, and you can select a pin color, and then you can actually click your mouse on the page and you can draw. Do you see how you can do that? I can show you with mine how you can do that.
Yep, I can see yours okay, but I cannot see how I can activate the pen. Where do I do that? That's all.
It's in your control panel. Well, looking on this chart, where would the highest high approximately be if you had to describe it spatially? Where would it be on the chart?
In the middle, but towards the right, that very large bar, which is
right here, right?
outside bar.
Yeah, so this would be the highest high. That's where you put the HH, and where would you put the LL?
Bottom right-hand corner, which is quite a small bar, but yeah, just there.
Right. Okay, so of those two, what's the first thing you want to do after you've marked those two?
Well, once I've marked those two and color coded or whatever I do,
Right.
I've then got to start the count.
Right. You want to circle the first of the
other.
two. You want to circle the very first of the two between HH and LL, whichever came first, you circle with a blue circle. Okay?
Yep.
I'd be up here. So I'm going to do that for you until you can figure out how to do your pin. I'm just going to do it for you. This would be where your blue circle goes. Okay, now that's the very dead center of that is where your first dot goes, and that's where your motion line begins. So where is the first motion line going to go after that?
Well, it's going to go down to the low of the second bar.
Right, down here, right?
Yep, and then the next bar after that is slightly lower again, so continue lower into that bar, and then lower into the next bar. And then the next bar is an up bar, so it'd go up. And then from there, it's pretty straightforward. It goes down the next two. Then we've got an inside bar, which I wouldn't take notice of. But then the bar after that is a higher high, and I'd go up. Then I'd go down, because the trend turns down to the next bar. And then here we have an outside day. We have an outside day, and it looks like I'd consider that as having taken out the previous cycle high, which was only a day earlier.
Right.
And so for that reason, I would have to draw it, I believe, to the low first and then go to the high.
That's it. So you go to low first and you go directly to the high, right?
Yep. And then I would go to the next low because there's a lower top, lower bottom day. Next day is an inside day. The day after that, I can't tell, but I think it's another inside day.
Yep.
But then I would take it to the top of the third bar. And then from there, I've got a lower bar, and then a whole host of 4 inside bars until I get to the second last bar. So I would draw it then down to the low and then to the final low.
So there you go. So that would be a good example of taking a brand new chart, marking, your highest high and your lowest low, picking which of the two came first. Do not circle both of them, only circle the first of the two in blue, put a little gray dot in the middle, and then you start your motion line. Okay, so I'm gonna have to erase all this before I continue. Okay, so let me go to the next page here. Let me go ahead and if you can put your mic on mute, Stephen. I'm gonna see if I can find someone else. Rohan, is your mic working? Can you see if you can unlock your mic? And okay, there you go. So can you hear me, Rohan? Your mic's unlocked, but I don't hear you. It shows you have a functional mic. Raju, let me try you. Raju, is your mic working? Oh, Nitin. Oh, Nitin, didn't realize you were taking this class. Nitin's been a long-term customer. Nitin, is your microphone working? I just unlocked your mic. Seems like we're having trouble getting everybody's mic. Balaji, your mic looks like it's working.
Yeah. Now I can hear you.
Okay, who is this?
Balaji.
Okay, Balaji. If you looked at this chart, where would your HH and your LL go? And do you know how to use your drawing tool? I can give you the ability to draw on the chart if it allows you.
Yeah, I'm just checking.
I just gave you the ability to do that.
Yeah. Yes.
You have to hold down your mouse key and press and hold it while you draw. Otherwise, it won't draw. So on this chart, where would your HH go and where would your LL go?
This would be H.
Yep,
HH.
that's right. Yep.
And this would be lowest low.
Okay.
LL.
Okay, so we're going to put a little dot in the very first of those two, right?
Yes.
Put it right here. Okay, so when is your first motion line going to be drawn and where is it going to go? Can you draw it for me?
Yeah, this is going to be a 3 continuous inside bar.
Right.
And it goes from here to here.
Yep. Okay, just keep drawing as quickly as you can so we
Yeah.
can get through this and see if you're doing it correctly. Yep, that looks good. Okay, what are you going to do about this outside bar?
This has not broken the previous high, so it's going to be in the same.
That's right. That's right.
And
Okay.
then
What's
up,
next?
up. This is going to be inside bar here.
Yep.
Here.
Yep.
This is again the inside bar here.
Okay, now be very careful.
Yeah. Okay. And this is down, down. Again, the inside bar.
Okay, I'm going to stop you here because this is a common mistake most people make. This right here defines what is a new financial impact.
Okay.
It has to be higher or lower than this. So if you follow that as your guide, what you're going to get is a chart that looks like, or a motion line that looks like this. We're going to end up skipping 20 bars in a row.
Yeah.
Okay. Because none of these made a new high or a new low. And then you had 4 more over here. So you have to be very careful when you're drawing your motion line that you're keeping track of where is the last bar to touch, and that until you get above or below, it does not count. Even though this was up in relation to this, it doesn't, none of these count. Okay. Okay,
Yeah.
so I'm going to show you another chart. Here was the highest high, the lowest low. Obviously this came first. This goes all the way back to the beginning of time, but generally you would just mark the highest one and then start the motion line. This one just went continuously downward. So as far as homework assignments are concerned, I want for your next class, each of you to pick one chart. It could be your favorite market, has to be a daily chart, only a 2-month time frame. And you want to pick the highest high, and it has to be up to date, make a current chart, not one that goes way back in time. So the most 2 current months, you pick the highest high, the lowest low, circle which one came first, put your black dot in the middle and start your motion line. And I want to see a few of the charts. We won't have time to go through everyone's, but I want to see a few examples. I'm going to, everyone send me one copy of one chart that you've done. We'll make sure that everyone's getting this motion line idea, and then we can move on to the next concept. Once this motion line process is done, then we can start talking about how we determine who's in charge of the market, because obviously we know from one bar to the next, either the buyers or the sellers are, but as you connect all these events together, it starts to create a more complex picture of a certain kind of buyer, a certain kind of seller. Are these trend traders? Are these bargain hunters? Are these top and bottom pickers? And that motion line and the way it behaves and how it connects over a period of time will start telling you a picture of the kind of environment you're in, which will then eventually dictate the kind of channeling that applies to that market and the kind of trading we should do for that particular environment. And then eventually we're going to involve multiple time frames and then get pretty sophisticated in incorporating fundamentals, technicals, and psychological elements to trading on 3 different time frames. We might have I'm not sure if we have time for this. Why don't we just leave it here and we'll start next time on page 39. Anyone have any quick questions about the homework assignment or about anything I've covered so far? Could quickly unlock all the available mics. Let's see, if you want to open your mic, you can do that, or if you want to just type in the question and answer section. Looks like most of the mics are unlocked. If you have a question, you can just quickly ask. Next time, I'm also going to discuss the structure of the river from a indicator standpoint, where we're going to break up each part of the river, the perimeter of the river, the trending part, and the acceleration part, and show what technical indicators and psychological fundamental indicators work at each part of the river. So you'll understand how this builds up and how we use each part of it to create trading for long-term, intermediate term, and short term. Okay, well, no one's asking any questions, nothing's coming in, so get your homework assignments next time ready. Now, when you send them to me, it has to be sent to a special account just for class students. So that's NEoWave, N-E-O-W-A-V-E, NEoWave at me.com, like you and me, NEoWave at me.com. And that's where you want to send a PDF of your chart, and then we can review it. I can open up my mail and go through the different charts and stuff. Okay, anyone have a quick question before we call it a day? Okay, well, looks like no. So I'm gonna go ahead and end the class here, and y'all have a good week and practice until next week, and then we'll carry on to the next step. This is gonna be a building process. There's gonna be a lot to learn and a lot to go through, but eventually the goal is to make you a very objective, unemotional, sort of professional, scientific kind of trader, not the typical emotional trader that most people are. Okay, well, have a good week and weekend, and I'll speak to y'all next week.